Here is the stock market analysis script for Bitfarms Ltd, BITF. The markets are currently closed as it is Sunday, November 30th, 2025. However, we must look at the closing data from the last active trading session on Friday, November 28th, because the price action we witnessed was nothing short of aggressive. Bitfarms Ltd, ticker symbol BITF, closed the week at exactly $3.48. That is a massive intraday surge of 12.26%, or roughly 38 cents per share, closing near the high of the day, which was $3.57. While the broader markets and even Bitcoin itself have been showing signs of extreme jitteriness, Bitfarms decided to decouple and run. If you are looking at your screen wondering why a miner is ripping higher while the underlying asset, Bitcoin, is struggling to hold the psychological six-figure line, you are not alone. Expectation versus reality is the name of the game here. The general expectation from the retail crowd, the folks checking Robinhood or SoFi Invest on their lunch break, is that Bitcoin mining stocks are just leveraged plays on Bitcoin's price. The math usually goes, if Bitcoin goes up, the miner goes up more. If Bitcoin goes down, the miner crashes. That is the expectation. The reality, however, is far more nuanced and interesting right now. The reality is that Wall Street is no longer valuing Bitfarms solely on how many coins it can mint in a day. They are beginning to re-rate this company as a critical energy infrastructure play and a high-performance computing asset that just happens to mine Bitcoin. When reality exceeds expectation like this, when the market realizes there is a floor of value based on power generation and grid stability rather than just crypto speculation, you get the kind of violent upside repricing we saw close out the week. Let's back up and look at the tape. The volume on Friday was significant. We saw over 86 million shares change hands. Compare that to the average volume of roughly 72 million, and you see that this wasn't just retail traders throwing darts. This was institutional accumulation. When you see volume spike 20% above the average on a Friday afternoon, that is smart money positioning for the week ahead. It tells us that the dip buyers were out in force, ignoring the noise around Bitcoin's recent slip below the $100,000 mark and focusing on the company's fundamentals. Speaking of Bitcoin, we have to address the elephant in the room. As of late November 2025, Bitcoin has been volatile, recently sliding back from its all-time highs and breaking below $100,000. This has caused a wave of panic selling across the sector. You can see it in the chat rooms and on the forums. People are worried that the cycle is over. But here's the contrarian take. The fact that Bitfarms rallied 12% while Bitcoin was correcting suggests that the market is forward-looking. They're looking at the difficulty adjustment, they're looking at the hash rate efficiency, and they're seeing a company that has successfully navigated the post-halving landscape. For those of you who have been following the saga since 2024, you know that Bitfarms has not had an easy road. The hostile takeover attempt by Riot Platforms back in mid-2024 was a defining moment. For months, it looked like Bitfarms was going to be swallowed up, but they fought back. They implemented the poison pill, they restructured, and eventually they reached a settlement in September 2024 where Riot agreed to a standstill provision until 2026. Why does this matter today, in late 2025? Because that peace treaty gave management the breathing room to execute. Instead of fighting a boardroom war, they spent the last 14 months upgrading their fleet to the T21 and S21 Pro miners. They focused on efficiency. When you log into your Fidelity Investments account or check your Interactive Brokers trading screen, you might see the PE ratio and think it looks ugly, but you have to look deeper at the efficiency metrics. Bitfarms has been aggressively targeting an efficiency of 21 joules per terahash and essentially hit that target earlier this year. In the world of mining, whoever uses the least amount of electricity to produce the same amount of random numbers wins. It's a game of margins. By upgrading their fleet and getting rid of the old, inefficient machines, Bitfarms lowered their production cost per Bitcoin. This means that even if Bitcoin hangs around $95,000 or dips to $90,000, Bitfarms remains profitable on a gross margin basis while older, less efficient competitors start bleeding cash. Let's talk about the specific operational wins that are driving this current momentum. The company has expanded its energized capacity significantly, pushing toward that 21 exahash per second milestone. They have operations spread across Canada, the United States, Paraguay, and Argentina. This geographic diversification is key. We all know the regulatory headaches that can pop up in the U.S. regarding energy usage. By having a massive footprint in Paraguay, where they utilize surplus hydroelectric power, they hedge their regulatory risk. It's a brilliant strategy. Use stranded energy that can't easily be exported and turn it into digital gold. This is the kind of ESG narrative that actually holds water, and it's why you're seeing Fidelity ETFs and other Fidelity wealth management funds getting more comfortable holding these stocks. Another massive factor that is often overlooked by the casual observer using the Robinhood app is the synthetic HODL strategy. Bitfarms was one of the pioneers in using long-dated call options to gain exposure to Bitcoin's price appreciation without having to pay the electricity cost to mine it. It's a capital-efficient way to leverage their treasury. In their recent reports, we saw that this program generated significant returns. It shows that the CFO and the management team are not just miners, they are sophisticated capital allocators. They understand that their job is to increase shareholder value per share, not just increase the hash rate at any cost. Now, I want to pause for a second and look at the technicals on the chart because Friday's move was technically significant. The stock broke above a key resistance level at $3.20. For weeks, $3.20 acted as a ceiling. Every time the price got there, sellers stepped in. Breaking through that on high volume is a classic breakout signal. It implies that the supply at that level has been exhausted. The next major resistance zone is up near the $4 to $4.50 range. If the stock can maintain this momentum and consolidate above $3.50 early next week, we could see a rapid move towards $4. This is volatility that rivals Tesla stock or Nvidia stock in their prime. If you're trading this, you need to be aware of the beta. This moves fast. While we're on the topic of trading platforms, it's interesting to note the shift in retail behavior. A few years ago, buying a stock like Bitfarms was considered fringe. You had to really dig to find info. Now, whether you're using SoFi Active Investing, Robinhood Fractional Shares, or Schwab Intelligent Portfolios, these mining stocks are front and center. They have become the de facto proxy for crypto exposure for people who don't want to deal with cold storage or private keys. This structural bid from passive flows, people just buying crypto baskets in their Fidelity mutual funds or Fidelity IRAs, provides a floor for the stock price. It's not just about the day traders anymore. It's about the structural integration of crypto equities into the broader financial system. However, we need to balance this bullishness with the risks. The reality of mining is that it's a race to the bottom in terms of revenue per unit of hash. The halving is always in the rearview mirror, cutting rewards, and the difficulty adjustment is always rising. If Bitcoin's price stagnates, Bitfarms' margins compress. That's just the math. Furthermore, we have to watch the energy markets. Bitfarms relies on cheap power. If global energy prices spike due to geopolitical tension, or if Argentina changes its industrial power tariff rates, their bottom line gets hit instantly. This is why the diversification into the U.S. via the Sharon, Pennsylvania site was so critical. It balances the geopolitical risk profile. There's also the narrative of AI and HPC. You've heard the buzz, but let's break down what it actually means for Bitfarms. Mining rigs are single-purpose. They do one thing. But the data centers that house them, those are valuable. They have massive power connections, cooling infrastructure, and security. Bitfarms has been signaling a pivot to use some of their capacity for AI workloads. This is the holy grail for miners because AI compute pays more and is more stable than Bitcoin mining. If they can successfully transition even 10% or 20% of their power capacity to hosting AI inference or training clusters, the market will re-rate the stock from a miner trading at 2 or 3 times revenue to a data center trading at 10 or 15 times revenue. That is the upside optionality that Friday's buyers were likely sniffing out. Let's get real about the competition. You have Mara, you have CleanSpark, you have Riot. It's a crowded trade, but Bitfarms has always traded at a discount relative to its peers on a price-to-hash rate basis. For a long time, this discount was justified because of governance issues and older machines. But with the fleet upgrade complete and the governance battle settled, that discount gap should close. If Bitfarms catches up to the valuation multiples of its peers, the stock has significant room to run, independent of Bitcoin's price action. I want you to stop and think about your own portfolio strategy here. Are you looking for a quick flip, or are you looking for infrastructure exposure? Comment below how many shares of Bitfarms you currently hold, or if you are waiting for a pullback to get in. I want to see where the sentiment is at. Are you bullish on the 100K reclaim, or do you think we're heading for a deeper correction? Moving into the future outlook, we have to consider the regulatory environment in 2026. We're approaching a midterm election year cycle in the US,